Well, welcome everyone. This is a presentation that we do once in a year. We talk about how to find the hottest real estate markets. And even though that's the name of this presentation, we end up talking about a lot of different markets at the end of this presentation. So there's a huge list of markets, let's call it 200 markets at the end of this list. And I pick out some of the ones that I like. Today, I'm going to be picking out a city called Fayetteville. I want to show you just how ridiculous its numbers are. Fayetteville in Arkansas. So I'm going to pick that one out, but I'll talk about another 30 or 40 cities. I'll give you some tips, and I'll also bring up the two cities that we voted for, Grocapitus voted for as the best cities to invest in for 2024. So we'll mention those. They're not technically part of this presentation. They're part of a different presentation that we did a few weeks ago, but I think it's worth bringing up those two cities as well in this presentation. And typically what happens is I do this slide, the ones that coming up on screen, and we talk a little bit about ourselves, but I want to do this a little bit differently today. So I am going to show you this slide. So this slide, it just blows my mind. I want you guys to understand what has happened in the United States, because I don't understand why there aren't 1,000 headlines about this. Okay, so you look at this chart, right? So here in August 2020, a few months after COVID started, right? The average home price in the United States was right here, 74, right? So look back at how reasonably priced homes were in 2012. This is 2020, a few months after COVID. This is August 2023. The average home price in the United States is now close to 115K. And just so you know, in the last 4 months, that number has gone up, not down.
I'm sorry, Neal,
This is
that's not the average
mind-boggling.
home price. That's what buyers must earn to
I'm sorry,
afford a home.
what buyers must earn. Sorry, that you're correct. So this is the earnings. Sorry. So in August 2020, you needed to earn 74K or 74.5K. Thank you, Anna. And today that number is shocking, right? So your income in 3.5 years, roughly, needs to have gone up by $40,000 to own a home in the United States. And that number for some of you who live in expensive cities may not be a lot, but this is the average in the United States, right? I'm going to show you what the number has gone up by in San Francisco. I live in the San Francisco Bay Area, and I used to live there, right? So this number is so mind-boggling that most people can't get their hands around how difficult it is to own a home, right? And so let me pick some cities, right? So San Francisco is obviously the poster child of how expensive it is. So in 12 months, the income needed to buy a median home in San Francisco has now gone up by $100,000. $100,000 in just this time frame, the last 12 months, right? So it's gone up from $300,000, which is outrageous, 300,000 median income, to 400,000 median income, right? It's just absolutely nuts. And there's so many places in the US where people are like, I don't need to live in San Francisco. I'm going to live in all these cities that are doing well. They have higher growth than the San Francisco Bay Area. What cities? There's nothing left. There's nothing left in the United States that is what I call inexpensive cities. Phoenix, you can see 121,000, right? Year over year, Phoenix is up 14%. 14% in a single year. Your income needs to go up 14%. Well, average incomes, according to ChatGPT, in Phoenix only went up 2.1% in the last year. US average, 115K. And it's gone up 15% year over year, right? And the median income of people that are actually buying homes is 75,000. So the gap is so astonishing. I cannot think of a time in the last 50 years, and please tell me if you know of a time that's better than that, where this has happened, this 3-year bizarre change. And obviously you think, well, prices will come down. They can't stay up that high. I mean, interest rates have been over 7% for 9 straight months. And during those 9 straight months where interest rates were over 7%, home prices have gone up. They haven't come down because there's no supply, and there's likely to be no supply for several years because of what we call the lock-in effect. My mortgage is locked in at 1.75%. So I really can't move, because right now, if I move, my mortgage is going to go up from $5,000 a month to $16,000 a month. I can't afford that. So I'm not going to move. 30 million Americans are locked in. They can't move, so their homes don't come on the market, and so very little is on the market. So that puts a floor under prices. So as a landlord, and I'm not talking about investing with me and Anna, you can go do this yourself. I just can't imagine a better time to be a landlord, because we've now in 3.5 years completely destroyed any chances that roughly 18 million to 20 million American families had. I got that number from ChatGPT because the question I asked it is, what percentage of the United States in terms of families and what count are now priced out compared to the day before COVID? And the answer it gave me is it's likely to be 18 to 20 million families. Well, those 18 to 20 million families, they're not just priced out for now, they're forever renters. So while the US has a lot of renters, we just added $20 million, 20 million families to that number. That's mind-boggling. Not in my career. And I've been building real estate since 2003 when I built an office campus to buying real estate since 2008. I've never seen anything like this. And I just don't think it gets enough attention that this is a horrible thing for America and an amazing thing for landlords. So I'll start my presentation with that. For those of you that don't know me, Anna and I, we are syndicators, data scientists. We buy and build properties throughout the United States. We do all kinds of stuff, multifamily, student housing, self-storage, industrial. There's about 5,000 investors that attend our multifamily webinar series. There's hundreds of you attending right now. This is not even our most popular webinar because we do it every year. We share a lot of ideas and thoughts and techniques by
And
which you can go out and buy, and data, but by which you can basically go out and buy properties. Maybe you'll buy them with us, and these are examples of maybe a third of our portfolio, maybe a fourth of our portfolio. Our portfolio is about $1 billion as built. Or you can go buy them for yourself. I think what I tell investors, what I love to tell to them is, try at least to buy one or two single family rentals yourself. Don't leave all of your dollars in the hands of Neal Bawa or other Neal Bawas, right? It's very good for you to be able to contrast being a landlord yourself versus investing into syndications with companies like us. I think that's a very good practice. So do both. And hopefully today will give you some interesting ones. But if you do them with us, I think you'll do well. These are just the average annualized returns that you can see. So in green, you can see what we achieved. In orange, you can see what we projected. And as you can see, these numbers have been absolutely phenomenal for the exits we've been having. Now, some of these exits, they were phenomenal for the primary reason that the market was very high. But we just had two exits, one in December, one in January so December last year, January of this year. And those were also phenomenal exits. And we're actually more proud of those because we had to deal with, all that interest rate increases, the cap rate increases for those two properties. So very proud about the two exits, and we'll update this slide for you later. So as you can see, many of our investors, a lot of our investors are repeat investors. They've invested with us 2, 3, 5, 10 times. And they have good things to say about us in case you haven't invested with us before. Now, one of the things that we do is on our website, there's a testimonials page, and we have lots of videos from investors, and those are really worth seeing. So if you're considering investing with us now, you might want to go to grocapitus.com. That's the website right there, and clicking on the testimonials page. Just 2 cents for a lawyer. I am not an investment advisor, neither is Anna. So this is an educational webinar. Every investment involves risk. Be aware of your risk tolerance level. You're free to accept or reject all the investment recommendations that I'm going to make. I'm going to make a truckload of those today. And everything's subject to market risk. And that our recommendation is not a guarantee of successful performance. So do lots and lots of due diligence. And when you're done, do a little bit more due diligence. So don't invest your money on our recommendations alone. Housekeeping, we will send a recording of this out. It might get sent out tomorrow. It might get sent out on Monday. And that recording will actually have the PowerPoint deck that you're watching. And it'll also have the Excel spreadsheet that I'm going to be using throughout this presentation. So both of those will be in there. So just watch, look for the button that gives you access to those. And yes, we'll take questions at the end. All right. So we talked about this. $115,000 median income, 18 to 20 million more people that are basically forever renters, and that's what's created the opportunity. So when I was doing this in 2008, I'm a data scientist. So I started asking this question of, how can I compare cities in the United States against each other? How many cities are there in the United States? I didn't know the answer to that question. There's over 1,000 cities. There's 323 metros or MSAs in the United States. And my question was, I want to invest in the one that's the best. And people said, there is no best. You just sort of invest in the area that you live in. And I wasn't satisfied with that answer because that's not an answer for a data scientist. We don't think that way, right? I wanted to find out which cities were the best. And so I started doing a ton of research. And over time, I came up with a set of rules. These are not perfect. They're rules of thumb. They seem to work a majority of the time. Tens of thousands of people are using these rules at this point in time. In fact, there's 13,000 people taking this course right now on udemy.com, a little over 13,000 people. And so it seems to work fairly well for almost everywhere in the United States. It's designed for single family. It also works for multifamily. It's not designed for any other asset class. So don't apply it to self-storage. Don't apply it to industrial. Don't apply it to mobile home parks. Just single family and multifamily. And I think you'll have good success. So I came up with 5 rules. Actually, we came up with dozens of rules that we use internally. But the 5 that I'm giving you here are the vast majority of what moves the needle. So the others that we have moves the needle a little bit, but it takes too much time and too much effort, in my opinion. I think most of the real gold is in these 5 rules. So my first rule, as you can imagine, is population growth. And I'm going to give you some numbers, and they may seem random, but they're not. I change these numbers every single year. Population growth. If the city is between 250,000 people and 1 million people in population, most cities in the US that you would be investing in are going to be in that 250K to 1 million range, then you want a certain amount of population growth in that city. What is that number? Well, for this year, 2024, that number is 11.2. Next year, you can come to our website, grab this PowerPoint, and the number might go up, it might go down a little bit. So, and those numbers are between 2 specific years, 2012 and 2021. And before you tell me we're in 2024, I know. But what I'm trying to do is to give you access to publicly available data. And I've run simulations, and obviously there's nobody that can give you data for 2024 yet. We're at the beginning of the year, but there is data, some data available for 2022 and 2023. My experience is if I go out and spend thousands of dollars buying that data, I end up with the same list of cities. Why? Because population growth doesn't change over years. It changes over decades. Cities just simply don't, have massive spurts of population unless something bizarre is going on with those cities, like a new Amazon headquarters. Other than that, it's a pretty smooth level of growth. So the fact that you have access to publicly available data through Google only up to 2021 is not a problem. You're still going to end up with the same list of cities, whether you buy $2,000 worth of software or you get it from Google. All right, so large metros are different. So on the screen, you can see some large metros. For those, that number that I gave you, the 11.2%, well, it has to be about 7% in that time frame, because large cities don't grow as fast as small ones. Now, what about the cities under 250,000 people, right? I gave you the number for 250 to 1 million. Well, and then I gave you the number for cities over 1 million. Now I'm going to give you a number for cities below 1 million. And for below 1 million, the number should be 15% growth in that time frame. Why? Because smaller cities are riskier. Well, if you're taking the risk, you should have the reward. So you want, and there's plenty of smaller cities out there in the US, right? If you want to get the best, well, in that case, 11.2% is not enough. You want to go up to 15%. Now, this number that I'm going to give you, I'm going to show you how to use it, and I'm going to give you an Excel spreadsheet. It'll be really simple. You don't need to write anything down, by the way. So 11.2%, this number applies to the second half of 2023, because that's when we updated these numbers, and to the entire year of 2024. It doesn't apply to 2025. So a year from now, if you want to apply this, you'll come back here. We do this presentation. You can also send us an email, and we send you this deck with a slightly different number. My guess is 11.2 might go up to 11.6 or 11, or it might stay the same, but it's not going to move too much. All right. So that's the first number that I wanted to show you. And before I go on to the second metric, I want to show you, where do you get this number from? So I'm going to escape out of PowerPoint, and I'm going to open up a fresh tab. And I'm going to type in the following words: population, Columbus, Ohio. This is the city that I use for my example. It's really a perfect city to use for examples, right? And by just typing these 3 words, population space, the name of whatever city you're looking for, and whatever state you're looking for. So you could be typing in population Greenville, South Carolina, or population Myrtle Beach, South Carolina. That's fine, right? The same sort of chart that you're seeing on the screen is going to come up, right? Which is awesome, right? Now, you notice that this chart only goes up through 2021 because publicly available data on population growth is through 2021, right? So you can see this city, Columbus, there's a reason why I like it so much. I call it the jewel of the Midwest. That's because it beats the absolute crap out of every other city in its state. A lot of times I like comparing cities within the same state, and Google likes it too, because you're seeing three lines, a blue line, a green line, and an orange line. Well, the blue line's Columbus, and you can see it's going up. And the Cleveland is the green line. Not only do you see it going down, have you noticed something? Every time there's a recession, right? One here, Cleveland loses population to Columbus. So when the going gets bad, the people in Cleveland leave and they run towards Columbus here and then also here. You see this? These spikes that happen in Columbus mean that at that point in time, because Columbus continues to gain jobs during bad times and Cleveland loses jobs, people leave Cleveland. Now, the third city is interesting, Cincinnati, one of the great cities of America. You notice that this city basically is flat. Now, whenever a recession happens, people never leave Cincinnati. This is the definition of what is called steady eddy. If you like investing in steady eddy cities, then Cincinnati is a great one and probably has good prices as well. But Cleveland, even though it has really inexpensive prices, may not be the best city to invest in, because do you want to invest in a city that is continuously losing population? And that the city that has been losing population continuously from 1990 to 2021, for 31 straight years, there hasn't been a year that Cleveland hasn't lost population. I want you to keep that in mind. Doesn't mean that there aren't good deals in Cleveland. All I'm saying is you may not get deals as good as you want. And my second and third data point, I call them real focuses, will really, really give you a sense of that, right? So within the same state, you can have cities that are doing really well, blue, Columbus, or cities not doing so well, green, Cleveland. And that's something that I emphasize, that the real estate is micro-specific, right? The same thing's happening in Arkansas. Little Rock not doing so well, but Fayetteville, which is 150 miles north, is doing really well. And this happens all the time, so you have to be aware of it. And that's what the real focus system was designed. So how do you use it? Well, there's an Excel spreadsheet. You're going to get access to this. Well, I go in and I plug in two numbers, the 2012 population and the 2021. How do I figure that out? Well, very simple. I mouse over all the way to the right, and you see a number. You see 906,528. I'm going to type this in here, 906,528. Hit enter. And then population in 2012. I move the cursor back until it says 2012. And it says 812,872. So I'm going to go in and type in 812,872. You notice the population growth is 12% over this time frame. Now, what did I tell you it should be? What was the number I gave you? 11.2, which is why you notice that the cell in this Excel spreadsheet has turned green. Just nice visual impact saying, yep, thumbs up, right? So real focus number one, population growth. Columbus does really well. Cleveland obviously is going to do really terribly because there is no population growth. There's a negative population. It's losing population. So if you plug the Cleveland numbers in here, you'd get something like -6 or -5 or some number like that. And obviously that's not a very good number for data-based real estate investment. Not saying you can't make money in Cleveland,